Welcome back. I'm Leela Rao, your host for Invest Wisely, your ultimate gateway to safe and prudent investing. Tax-deferred retirement plans such as the 401k or IRA are great vehicles for investing for your retirement. You must absolutely make use of all the advantage that you can avail by efficiently investing in this way. But the question is, will the amount from such a portfolio sail you happily and in abundance during your retirement years? No, not really. I can tell you for certain that for many, when they see their retirement portfolio at the time of retirement, they are gripped with the fear that they may outlive their savings. What are the chances that you will run short of money in retirement? An individual or family is considered to run short of money if their aggregate resources in retirement are not sufficient to meet aggregate minimum retirement expenditure defined as a combination of basic expenses from the Bureau of Labor Statistics Consumer Expenditure Survey and some health insurance and out-of-pocket health-related expenses plus expenses from nursing home and home health care expenses, at least until the point they are picked up by Medicaid. Well, this for the definition of what is running short of money. Now let's see some facts with numbers. The 2010 EBRI Retirement Readiness Rating from the Nonpartisan Employee Benefit Research Institute finds that well over a third, that is 41% of Americans in the lowest pre-retirement income level will be running short of money after 10 years in retirement. In addition, the EBRI Retirement Readiness Rating finds that after 20 years of retirement, almost a third, that is 29% of those in the next to highest income level will run short of money, as will more than 1 in 10, that is 13% of those in the highest income level. Not surprisingly, those with the highest income are at the lowest risk of running short of money, but mind you, many in the highest income category will still face significant risks of not being able to pay basic expenses and uninsured healthcare expenses in retirement. Furthermore, as I mentioned earlier, there is an increased chance that there would be a huge reduction in Social Security benefits. Well, now don't think I'm scaring you here. It is better to think of the worst case scenario and prepare for the best in life. This is what I do for my clients in practice, and this is what I wish to share with you here. The best method to keep in track to meet your retirement goals is to do a periodic retirement checkup. Yes, I know what you're thinking. This is very similar to doing your annual health checkup with your medical doctor. Here, you're doing your financial health checkup with your portfolio manager. Remember that your retirement strategy changes with the changes that occurs in your life as time goes by. So, a periodic checkup will allow you to stay abreast to meet your goals. Let's now see how to go about this. Step 1 is to identify your resources available. This would include current account balance in your retirement account. You also need to note your current savings rate and the return in percentage your retirement plan provides for you. Apart from this, you make sure your retirement portfolio is invested in line with your agreed upon asset allocation. If you note any changes to your agreed upon plan, pose questions to the relevant authorities or to the provider and get answers, that is, if you are investing in a plan with your employer. Step 2 would be to determine how much money you would need at the time of retirement in order to maintain or better your lifestyle. If you are not able to calculate this by yourself realistically, your portfolio manager or financial planner will be able to guide you in this. Step number 3 is to choose a suitable asset allocation to invest the funds you have available currently in your account. For this step, you need to determine an asset allocation or investment strategy that might best produce the investment return you need to reach your retirement goals. You should also review the materials given to you by your plan's investment provider to determine what your options are. Indeed, several investment websites and online brokerages boast that they provide asset allocation tools. Asset allocation is a specialized step in investment management, and here I would advise you seek help from a well-qualified professional portfolio manager. Set up suitable rebalancing strategy as well so that Periodically, your portfolio is rebalanced to the amount you have invested in your different options to reflect your targeted asset allocation. Final step would be to make it a point to set up a reminder to do your annual checkup next year at the same time. Now let me tell you this, it is not always sufficient to invest for your retirement just the amount the IRS allows you in different tax-deferred vehicles. It is also important that you start a parallel portfolio and put away a little every month and invest using dollar cost averaging with a qualified portfolio manager. Dollar cost averaging is a method by which, instead of investing assets in a lump sum, the investor works his way into your position by slowly buying smaller amounts over a longer period of time. This spreads the cost basis out over several years, providing insulation against changes in market price. Though I would strongly advise seeking professional help, you could also set up a portfolio and try doing it yourself if you have the knowledge and expertise to analyze and research investments. But if you do not have the expertise, do not trade with your hard-earned money. You are better off putting it in a well-diversified mutual fund every month. Coming up next is question time. Stay tuned. Invest Wisely will be shortly back after the break. Welcome back. I'm Leela Rao, your host for Invest Wisely, your ultimate gateway to safe and prudent investing. I have a question from Mr. A. Patel from South Carolina. He asks, I and my wife run a small business and wish to set up a retirement portfolio. What would be the right vehicle we could use that would benefit us and also be cost effective and less onerous? Thanks for your interesting question, Mr. Patel. The right vehicle for you, that is assuming that you and your wife are the only employees of your business, would be small business owners 401k or SBO 401k as it is called. For eligibility purposes, your spouse is considered an owner of your business. If your business has non-owner employees who are eligible to participate in the plan, your business is not suitable to adopt the SBO 401k plan. In other words, your business may be eligible to adopt this plan only if the other employees in addition to yourself and your wife are not qualified to participate in the plan, say because of age restrictions or any other reasons such as they do not meet the number of years in service requirement. When compared to other retirement plans, the SBO 401k plan has high contribution limits, which is the most important component that attracts small business owners. The SBO 401k plan must be established by the last day of the tax year for your business. If you operate your business on a calendar year, the deadline will be December 31st. The documentation involved is less than other plans and hence is cost effective. Let's say, for instance, a 30-page document for the regular 401k plan may be reduced to a 3-page document for the SBO 401k plan. Make sure that you receive the proper documentation from your financial services provider. We welcome you to write to investwisely@tvasiausa.com with your questions and comments. Alternately, visit the following address shown on the screen to be directed to your question form by double-clicking at the bottom right-hand corner where it says Read More, click here. I am Leela Rao signing off for the day. Until we meet again, remember, do not feel rich earning money, but invest wisely to be truly wealthy. Thank you.